Brian, I've heard about universal life policies, I've heard about term life insurance, and I've heard about whole life insurance, but we're talking about fixed index universal life insurance. What is the difference between an FIUL and those other things I mentioned?
Yeah, so the basic form of life insurance is a term insurance policy. So that is strictly life insurance. You pay the premiums for a period of time, a term, say 10 years, 20 years, and if you die during that period of time, then the insurance company will pay your heirs. That's all it is. Now, when you go into whole life, or especially fixed index universal life policies, they're combining a term insurance policy along with an investment product that the insurance company is offering. So it allows you to grow an underlying account balance within the policy and have life insurance. And one of the key attributes to life insurance is that it will be someday income tax free.
Okay, so it does have a tax advantage to it. Who is best suited to use a fixed index universal life policy?
Yeah, there's a number of ways you can use it. I mean, like I said, it is a kind of a secure investment kind of strategy. It does have an annual floor to limit losses if the market goes bad. So that's a good attribute of it. There's a lot of interesting attributes, but it's best suited for people that who qualify for the insurance. We'll talk about that in a bit. It's best suited for somebody that wants income tax-free cash flow in their retirement years. That's a primary use of it. The other use is for if they want to leave money to the next generation and they want it permanently there. They want to have something they can leave behind as a legacy asset. A term insurance policy doesn't have that. You buy it when you're 40 for 20 years and you pay on it until you're 60. Well, it runs out. If you pass away when you're 80, there's nothing left for your heirs. But with a fixed index universal life policy, there will be something left for your heirs, and it can be income tax free.
So Brian, this sounds like sort of life insurance for the living, right?
Yeah, that would be the cash flow aspect of it. So a lot of people think, well, I'm not too excited about investing in life insurance because that just means somebody gets more money when I'm dead, right?
Right.
Well, that would be my first thought on that, but that's not what this is. A fixed index universal life strategy is typically done for somebody that wants to build money within the policy in their 30s, 40s, 50s, or 60s, and then take money out in their retirement. Now, how do you do that? I haven't died yet. How do I get paid? Well, once that cash value has built up enough, then you can start borrowing against your own future death proceeds. The insurance company knows you're going to die someday. They don't care if they pay you early and charge, interest to the policy now or pay you later. So it doesn't matter to them. So if you want to start borrowing down the cash value of the investment within that policy, you can. So you basically can borrow monthly and create a pension-like cash flow in your retirement that happens to also be income tax-free. And the reason for that is that borrowing is not a taxable event. Mm-hmm. And when you eventually die and the insurance company pays back the loan and interest and the rest to your heirs, the rest of the policy value to your heirs, life insurance is income tax-free too. So the loans that you took were tax-free and the life insurance proceeds are tax-free. You've just created a tax-free pension-like stream of payments in your retirement.
I like the tax-free part about that. Who can qualify for an FIUL?
Well, that's one of the reasons why we don't, why wouldn't everybody be doing this? Well, first off, you have to qualify physically. So if you've had maybe a cancer scare or something like that, the insurance company may not cover you. The other thing is, if you're 70 years old and or 75 and listening to this saying, I want that, well, it doesn't really work for that for two reasons. One is you need a long time for this to build up its value, at least maybe 15 years before you really want to start taking money out. And the other thing is, as you get older, the underlying cost of insurance is really high. And so these really work great for younger people, and younger than 60 is certainly a time to be looking at it. Certainly younger than 50 is an easy call because you're more likely to qualify, pass the physical, and you have more time on your side. So time is a big friend of these, the time value of money compounding over the years, so that later, like when you're in your 60s, you want to retire and get those checks, you can take those monthly checks income tax free.
So why would someone not want to do a fixed index universal life policy?
Well, maybe they don't have any insurance needs. Now, most people that I put into one of these don't really buy them for the insurance. That happens to be another benefit, an attribute of them. They have a lot of attributes actually, but the reason somebody wouldn't generally is just because they don't qualify or they're too old. Those are really the two main reasons. These can be used for cash flow, as I mentioned, but they can also be used to leave money to the next generation. You can combine these into trusts and so forth, and other ways to get money to the next generation tax-free. But I don't really have a lot of answers as to why you would not use one, because if you qualify and you have time on your side, I haven't really found a whole lot of things that work quite like a fixed index universal life policy.
So the key here is if you qualify and you have the time, then it very well could be a good strategy for you. Can you give me a case study or an example